Thank you so much for joining me today. We're going to be talking about the solution for contract cancellations and price reductions. And we're going to be talking in context to the seller buy down options and how this solution can help you. I'm going to go ahead and share my screen and we'll get started. And as we go through this, we'll be talking really about the housing industry as well as a seller buy down. So I'll link the two together. I think it's very important that a lot of people talk about, why, if people can buy, but I also think it's important to talk about whether they should buy. So I'm going to link those together too for you in this. Big problem right now, contract cancellations are skyrocketing. Buyers are trying to lowball sellers, causing sellers to cancel listings. Sellers are wasting a ton of money due to significant price reductions in the market. And the question is, do you have a price reduction mitigation strategy? What we're looking at here is, what are you seeing in the market when it comes to cancellations and price reductions? I know we have comments turned off on this, so go ahead and leave your comments, and I'm going to address those after. So go ahead and leave comments in there, but we'll be addressing after that for time's sake on this. We've been asking this question in a lot of our meetings, and we are seeing it. We have the data around it. We have seen cancellations and price reduction all-time highs, which is leading towards active listings increasing. We have the data behind what's going on with median home prices. We're starting to see this level off, and not a huge drop. Well, we'll see what happens at the end of the year, but we are seeing these prices somewhat stable overall. But what we are seeing, though, is deals are falling through at the fastest clip since 2021. All-time highs when it pulled the data as of July. Deals are falling out of the market. We also see more price drops than ever before. Since 2015, we've seen more price drops since dating back to 2015 and beyond. So this is a big deal. We're seeing price drops. So what we're seeing is we're looking at really two different components here. Do you believe, and again, I have comments shut off, so I'll kind of give you my thoughts on it, but why do you think price drops and cancellations are happening nationwide? Why do you think that is? So what we are looking at is a few different things. Home buyer mortgage payments for home buyers are up over 43% year over year. We all know rates are up. We'll address that in a minute. But payments are also up. So how do we address this? Mortgage payments have jumped up. They're actually a little bit higher than that now based on the rolling average in interest rates. They're higher than home buyers have seen in a long time. So the question is this an affordability problem or a pricing problem or affordability problem? So is it a home price problem or affordability problem? Our buyers aren't right now really scared off by the home price. They're more worried about the monthly payment. So be aware that it's not so much the price of the home, but it's more about the affordability problem of the home. I'm going to jump into interest rates really quick. I want to address some slides that we just did a presentation on that I think it's important to understand what inflation is. Inflation is too many dollars chasing too few goods. Too many dollars chasing too few goods. Okay. So what's happening now, because they've injected in money into the economy over the last couple of years due to the pandemic, to make sure we didn't have other issues in the economy. So somewhat needed overall. Now, what they've done is they have continued to pump in money. They've also, as supply chains improved, we've seen inflation loosen up a little bit, but really inflation still at this time, October 2020, we're still seeing inflation close to 8%. So one of the things that really drove this was the QE period. We saw them do quantitative easing. What that means is the Federal Reserve was buying mortgage debt to suppress mortgage rates. So they were a buyer of the debt to keep rates low. They have stopped doing that, which is increasing rates. The reason why this is important to the seller buy down is because we want to know what's going to happen in the future to rates. So as they kind of try to understand how to adjust the inflation, when will inflation peak? Hard to say exactly when. Some people are saying, somewhere in the range of 2023, 2024. They got to get this thing to peak and go the other direction. Fed is hiking rates right now. So what is that going to lead to? And historical data will show that this leads, Fed hikes lead to recessions. As they raise rates, the Federal Reserve, and they stop buying debt, which was suppressing rates, they are then going to create a recession. And that's really what they want, because they want to slow down the economy. We have a yield curve. Typically, short-term rates are lower than long-term rates based on a normal yield curve. Right now, we are saying short-term rates actually higher than long-term interest rates. You can get a 30-year in some instances at a better rate than shorter-term rates based on the treasuries. Also, as this yield curve inverts based on the 10-year treasury, we also see recessions. As the yield curve inverts, we see recessions. So we believe that as the Fed raises rates, we typically go into recessions. As we see this yield curve inverting, we also see inflation or in recessions. The other thing on interest rates, unemployment, the Fed has specifically said, I can't see a recession without a 3.7 unemployment rate. 3.7% is very low. They want to see this number actually go up before they start seeing and loosening up on interest rates. So that's something else to watch. Unemployment rates have been all-time lows, very, very low right now. Until that number starts going up, we're not going to see necessarily any changes to the Fed's decision. The other thing that during recessions, mortgage rates during recessions, typically, once you have a recession hit, you see rates actually go down. So keep that in mind. If rates go down in a recession, then if we do believe a recession will come because of the data we just went over, then what's going to happen to interest rates? We believe that they're going to go down, and that's going to play into why the seller buy down makes a lot of sense right now. The other thing too, for buyers out there, is important to understand that housing has always remained strong through recessions. So if you go back to 1960 and you look at all the different recessions through time, the only time the housing index price index actually fell during a recession was during the subprime crash. And subprime crash really was less about subprime mortgages. It was more about the huge the inventory or the building of houses that we had. We had a huge amount of houses being built to be sold off. There was not enough household growth or formation to be able to buy up the property. So we have not been building for a good 10 plus years, just started really ticking up in 2015 and 16. But due to supply chain issues, we didn't build as many houses as we really needed to in 2020 and 2021. So here's the issue. We have more 33-year-olds than ever before. 33-year-olds are hitting our market right now. So this is something that is pushing the demand higher. Remember, the supply is lower because they haven't been building. We have high demand because of household formations, household growth and formations. The blue lines here are higher than they've ever been. And we have more 33-year-olds generationally speaking than ever before. This is causing a situation where housing is still in demand. And we also have a lot of money supply, which is pushing up pricing. What's going to happen with pricing, including housing pricing, if people don't go buy a house because they're worried about the interest rate, they're going to go rent, which is actually going to push up rents even more and reducing the supply of rentals, which is going to make people, investors, want to buy rentals because the rental market is strong. So that's another reason why it's better to buy a house, even if you're a renter or an investor, or a buying house comparing to rent. These are some great reasons to buy. Okay, so I like to talk about this before I jump into the numbers of the seller buy down, because it's important to understand what we're trying to solve for and why it's so important to still help people buy housing rather than not buy housing, because it's one of the best generational wealth machines that we know of and we've seen historically to have. You're paying for a mortgage one way or another. You're either paying your mortgage or the landlord's mortgage. So we much rather have it pay you paying your mortgage, or you're making sure your client, if you're a realtor, that we're helping the client buy a house. If you're a financial advisor, I think it's important to have them understand what the benefits of housing is. And obviously, I'm not a tax guy, but there's a lot of tax benefits as well. Talk to your CPA. So here's the solution. So remember, going back to the question, is this a price problem or affordability problem? Okay. We believe it's an affordability problem. So how do we solve for the affordability problem? The solution is the seller paid rate buy down. This strategy has three main benefits. The buyer will have a lower monthly payment and pay a lot less interest over the life of the loan. Number two, the buyer will be able to qualify for higher loan amounts and better properties. Number three, the seller wins as well. The seller wins because the buy down strategy is 300% more effective and in improving the affordability for the buyer. If affordability is a problem, remember, that's what we're trying to solve. And there's really two different types of products. I ran these scenarios, so interest rates may be up or down when you're watching this. So just be aware of that. But interest rates in this example, permanent buy down is basically just paying points. This is kind of your old plain vanilla. You're going to be getting the seller to pay extra points to buy down the interest rate. They buy down the interest rate by paying points, and you can either go higher in rate and pay no points, or lower in rate and pay points. Now, in this case, if you paid 1 point, you save about $100 a month. If you paid 2 points, you save about $200 a month. Long term, that's fine. If you think rates are going to continue to go up, this is the better option overall. If you think rates are going to go up because you'd be in a fixed payment long term, this rate would be bought down permanently, 30-year fixed in this case. Okay. Now, there are some break-even points and how quickly recoup the cost, and it may or may not make sense to pay points depending on how long you're going to be in there. But that's kind of the simple version. The other version is what's called a 3-2-1 or a 2-1 buy down. In this example, we're going to talk about 3-2-1 buy down to show the maximum savings. The 2-1 buy down would just be removing one of the years. You actually start at year 2. The nice thing about this is it's a fixed rate at the going market rate. So if you were paying no points, and let's say the rate was at 7.75 on a regular loan, call it this one here, you're going to be at the same rate. So there's no real necessarily big hit. And there might be, depending on different credit scores and different loan terms. But when I ran this one, there's no pricing difference using a temporary seller buy down. Now, what the difference is here is you are paying into, the seller has to pay this. The seller pays into what's called a custodial account. This money is then held in the account and subsidizes the monthly payment for the buyer. That payment would have been $27.97 but actually starts off about $770 lower for year one. That comes out to a theoretical rate of 4.5. What they're doing is this money subsidizing the payment. So it's basically buying it down temporarily for the first year. Second year is going to be bought down, just not quite as much. It would be a $525 difference and some change. And then third year is $268 and some change. All what's happening is this money here that's in custodial account is actually being reduced each month, dropping down. At the end of it, it's going to be zero in that account. Now, here's the beautiful thing. At year 4, the payment is fixed in. So let's say we're wrong about rates and the rates keep going up. Well, it's fixed in. So you'll be very thankful if the rates keep going up, you'll be very thankful that you have a fixed rate. And if they don't, then you refinance out of it. But here's the cool thing. Let's say in year 2, in this example, rates go down and it's either at or lower than your temporary. And you're like, all right, let's do a refinance that makes sense. You will get back whatever's remaining in the custodial account. That is money that goes back to the buyer of that house as a principal reduction. And there's some terms around this. So if you have late payments, this money cannot be used for paying your late payments. It can't be used for other items to fix up the house or other things. It's specifically only for the buy down here. Okay. The only reason you get it back is if you sell or pay off the mortgage or refinance, that the balance would be reduced by whatever's remaining in that account. Okay. There are some specific percentages based on purchase price that the contributions, there's max contribution. So if somebody's putting down different down payments, it'll affect the amount the seller can contribute. So you have to be a little careful here, because if you have the seller contribute more than is allowed by the lender, then the money, you'd have to renegotiate the contract. And talking about contracts, I'm not a realtor, so you want to check with your realtor on this, or in some states, your attorney. Make sure there is a page that's going to go in that you're specifically going to have to talk about how much what this is specified for. So be aware of that. Make sure that your money is actually being specified for exactly what you're talking about. Lost my light here. Let me fix that. So make sure you actually have the money in the contract dictated to going towards the buyer seller paid buy down. So just make sure you talk with your lender about that. And when you're structuring that, this is important to know that there are different percentages, and I left it on the screen for a little bit so everybody can see that. There's different strategies. So these rates are not the going rates. So just be careful. I want to make sure everybody knows that these rates right here are as an example. It's a case study. So, but I want to show you what this could mean, and we can put different presentations together. This one I did about a month or two ago, a couple months ago over the summer when rates were a hair lower. So if you look at this market rate price here, in theory on this one, if the market rate for the house was 675, and let's say that going interest rate at the time, again, not right now necessarily, that rate would have been somewhere in about 5.5 when I priced that out a few months ago. Price reduction. So there's offers that are going on in this. The buyer can come to the table and ask, hey, I want to get a price reduction. So in a lot of people's mind, it's a price problem, but it's actually an affordability problem. So the buyer comes to the table and says, hey, I want to make an offer on the house at $650. But the seller doesn't want to reduce the price that much. So the seller can counter with a seller credit and work with the agents, because I think working with the agents and creating a win-win is important. If you can create a win-win, in this case, what we did was we created a $12,500 credit. And the goal was to lower the monthly payment, because the buyer's concern was more of the payment. So what we did was we did a $12,500 credit to buy down the payment and mortgage insurance. You could do different things where you buy down the rate, maybe buy out mortgage insurance, maybe do something in between. This is why it's important to work with a good mortgage professional, because there's a lot of different options. This case, you can drop the payment by $300 a month. Okay. And so you end up getting a higher price for the seller. So the seller wins. The market wins, because you don't see these big price drops hurting everybody else in the neighborhood. So the seller wins. The agent wins, because they're not giving up their commission on the lower price. The buyer wins because the payment's lower. And then you have your cash to close is almost the same. So the buyer's winning again, because they're not bringing in more money. And so it's really creating a win-win for everybody. So buyers, sellers, and the realtors involved, and really helping everybody. So what would it take if somebody said, hey, I just want to try to drive down the price because I want to get a low payment. And if I think low payment, I think low price. Well, if you had to go down in price to get the same payment as you would have with the buy down strategy and using the credits, you would have had to lower the price to $616,000. Okay. That would significantly hurt everybody involved. It would hurt the seller of it, because the price would be a lot lower. It would hurt the buyer of it, because they're really pushing down overall comps in the area. So if they ever needed to get a home equity line or refinance, it could actually affect their potential ability to access capital. And then so really overall in the payment, so the payment would be still $3,500 a month. So in this case, it's $3,500. Now, the caveat here, of course, if you can get a lower price on the house and the sellers go with it, by all means, negotiate down. But what we're talking about is in this market, if you go too low in price, the sellers are just not going to sell, or they're going to take it off the market and try again in a couple of years. What you're trying to do is come up with a win-win that works for everybody. Okay, so we have different examples. Breakdown of these. Again, these are all examples, so not real-time pricing. So just know that. VA options. We even have jumbo buy-down options too. So I'm going to leave you with this. These are some questions to help, just start thinking about this. What buyers are you working with in the last year who didn't end up buying a house due to rates or inventory? And if you're a buyer listening to this, think about if you're a buyer, maybe this will help you as well. And what buyers, number two, what buyers are you currently working with that aren't getting offers accepted due to a lowball offer, or they can't qualify for enough of the home? Okay, so if you're offering on houses and you're losing out because of you have to offer lowball offers, this might be something that you could work on if you can get that payment down and qualify. The other one is, what homeowners have you talked to in the last year that expressed interest in moving but didn't end up doing anything? Again, if you're a homeowner watching this, just remember, if you were trying to buy something in the last couple of years, 2020, 2021, oh man, in early 2022, you were probably going up to against 10, 15, 20, I've heard 30. I heard one that was 100 offers. So this market is very different, where we can actually negotiate work. Maybe you have one or two offers you're working on. It makes it so much better for the buyers, and I'd say the realtors and sellers. So here's what's really cool. The last one is, are you working with any sellers who contemplated a price reduction? So what I'm seeing too is maybe they're thinking about a price reduction. They're coming up with a solution. They're trying to figure out a solution to what they need help with, whether that's moving closer to their, church they really want to go to, their kids where they're living at. They want to downsize, upsize. They need the extra bedroom. They got to be closer to work, whatever it is. Okay. So just keep this in mind. It's really, really important that, we look at why people are doing something, not just at what price it is. Really understand the need of the homeowner, the seller, the buyer, everybody involved in the transaction. And how do we come up with solutions to help buyers right now? If you're interested in a seller buy down loan comparison for your clients or for yourself, please reach out to me. You can either text us at 480-553-8770. You can email us at team@kevinbrierton.com. It's on the screen. Or you can schedule a discovery call at mortgagestrategycall.com. That is mortgagestrategycall.com. We'd be honored to help. Thank you so much for watching. And again, I'll check the comments and I'll be reaching out to everybody after we go off live. Have an awesome day. And again, thank you so much for watching. Take care. Bye.